Stock market versus real estate, investing, experiences from an expert real estate investor and agent. Hi, I'm Amol Heda with Keller Williams Bay Area Estates and author of Thriving Through Ownership. I take pride in being an agent. I'm a licensed broker also, and I am an investor too. Did I learn everything overnight? No. I have 2 decades of experience and I've been working 2 decades in real estate. Not just that, I take huge pride in helping understand my client's profile, diving deep into their needs, in what they are, what their risks and tolerances are, and what are their wants, what do they look for their future. So I go through everything, and so when I do real estate, I call that as real estate by design, not just selling real estate. That's not my business, not just my business. So let's first understand what is investing, what do we expect of investing. Number 2, what do we do when we invest in the stock market? What are the factors, criteria, returns, risks? And the same thing we'll do with real estate. And so we'll compare and contrast what is investing in stock market and how can you invest in real estate and how this will play out. So first of all, in the stock market, we invest in order to see appreciation. The best part of stock market is that it's very liquid. You could buy a Google stock today and you could sell it tomorrow. Nobody can stop you from doing that. So liquidity is the key when it comes to the stock market. Secondly, you can take money in small chunks and keep investing as you go. In real estate, that's not the case. In real estate, you need at least a down payment to be able to invest in a big chunk of a property. So the big differences are how much money you need to get started in stock market versus how much money do we need to get started in real estate. That's a big difference. At the same time, in case of real estate, we can start with barely 5, 10, 15% down, 20% down. Show me that anybody bought in the stock market at 5, 10, 15, 20 or 25% down. So that's another big difference. In real estate though, in stock market, you are completely hands off. That is, you don't necessarily manage the investment or the business itself. Whereas in case of real estate, you have to manage or you have to go and work with a property manager or a property management company. So these are the high level differences. Let's now talk about risks versus returns. So, stock market, we invest in stocks. We take it from, we look at the stock, how it has appreciated, we look at the percentage and we guess that it will keep growing at that same rate. Even though you will see a lot of places where they say, past returns are no guarantee of future performance, you will still see that that is one main criteria when it comes to stock market investing. In case of real estate, you look at the long-term averages and you invest in there. Your money comes back to you in 2 forms. appreciation and rental income if it is an investment property. If it is not, then you will only get, like when people invest in land, you get no return, just appreciation only at the point of sale of the property. So that's the difference between these two. So in case of stock market, you get appreciation or growth and you get dividends or return. And if you are doing bonds and such, then you get interest, and the value of the bond could appreciate or depreciate depending on the direction the interest rate takes. But these are the things. So based on historical analysis, the returns in the stock market have a built-in volatility. The returns in real estate are not that volatile. In case of real estate though, if you are going to buy and sell within 1 year, then you're probably going to lose the entire gain probably for the 1 or 2 years. Say the gain is about 6% per year and you sell within 1 year, your closing costs themselves will be about 6 to 7%. And that will completely take away the profit that you could have made or appreciation that you could have made in 1 year's time. And so that's one point to look at. So in real estate, you cannot be very short term. You cannot play by the hour. You cannot be a day trader. I mean, of course, being a day trader is very counterproductive even in the stock market, because you buy and sell in very short cycles. You don't really necessarily book that much of a profit. And when you're being a day trader, you are essentially subjecting yourself to some huge short-term tax liability. And so we have to figure the balance out on that particular aspect. In real estate, so for the Bay Area, for records, go and look at my video, Stock Market and Real Estate Compare, on my YouTube channel. I mean, right here. I'll probably post the link here at this place. You can watch that video, Stock Market and Real Estate, how do they compare? I did that video actually when I saw a news item which said that a home that sold in 1956 for $15,000 in Redwood City sold for $2.25 million in 2022. So in 65 years or so, that was about 7.5 or 8% appreciation at a compounded annual growth rate. There is a compounded annual growth rate calculator. You should perhaps go and see, put your numbers there and plug in and see and play with it, how that works. Anybody would be shocked that, oh, just $15,000 in 1956 became 2.25 million in just 65 years. That number is shocking. And so I put that video. So in real estate, over a long period of times, you make very good money. And note that the down payment that the person must have done at that time in 1965 must have been only 20%, which was $3,000. So guess, $3,000 became 2.2 million. So that gives you a return of about 11.5%. Not just that, think that that family or household saved rent all the time. For historical records, I went and looked at the rental numbers in 1956, and they were about $400 a month in Redwood City. Today, that rental number is about $5,500. So it doesn't seem like big, but what I did is I averaged these two, and between 5,500 minus 400, it becomes about $3,000 of rental income on an average over 65 years. So 3,000 times 65, that number turns out to be about $1.7 million. Add that to the net realized amount, and you will see that they got about over 12% compounded annual growth rate. I have heard of the stock market doing the same. The S&P 500 has been doing 10% plus. So there, real estate beats that number big time. And guess what? Real estate, you leverage. So $1 works like 5. You go with 20% down payment. So $1 million property can be bought at $200,000. What happens when you do the same thing in the stock market? Has anybody played the stock market? $1 million with 200? No. The margin account allows you to go only to 50% margin. So 1:2, not 5x. So that's a big difference between real estate and stock market. You get to control 5 times the asset in a home, in a primary home. And now there is real estate, they are allowing investment properties to be done. If you lived in it, if you are living in a duplex or a fourplex, they allow you to do only 5% down payment. Just imagine, even if it is a $2 million property, you are putting only $100,000 down. So leverage is a huge difference between real estate and stock market. The stock market, you cannot leverage, or people think it's extremely risky when you leverage. Whereas in real estate, you start with leverage, and that to 5x. So at the same time now, in real estate, you take on a liability. You need to make that much money to be able to pay that much back. So that's a liability. In stock market, you're not taking a liability. So that's a big difference between real estate and stock market. So you're committing to making monthly payments and you're paying interest to somebody in order to achieve that growth and that income. So in stock market, you don't leverage, and so there is no liability, and so your money is 100% deployed. Now guess what happens though? That when you buy real estate, and say you bought a $2 million home here in the Bay Area, and you bought it with no loan, you bought full cash. Say tomorrow the home values drop 50%. So the home becomes 1 million from 2. Whose money is at risk? Yours or the lender's? So guess that. Actually, people invert the concept of liability big time. And so realize this, that when you don't borrow money, you're taking the entire risk. When you borrow money, the lender is taking the risk. That is why they are so careful. They want an appraisal, they want underwriting, they make you sign documents, no end in your blood and all that, right? So that's the difference between real estate and stock market. In stock market, when you invest everything in say Google or some ETF, and that ETF gets wiped off, whose money is gone? Yours. And if that becomes a penny stock, do you think it will come back? Most likely not. I have been hit. I'm a very aggressive investor, and so I have been hit by such losses multiple times. One of the times I saw Google go from $65 at IPO to $350, $250 IPO. I said, this is unreal. In 4 months' time, this is going berserk. I'm going to not believe in Google that much, and I'm going to short the stock. And guess what happened? I shorted it. And after I shorted it, Google kept on marching, and I finally closed the position at $325. You know what? I lost $40,000. And after that, I said, no, stock market investing is not for me. So you need to understand how to play the stock market. And that is a skill. And I tell my clients that, when you play the stock market, when you're doing your own full-time job, you're taking yourself away. And here in the valley, where people make great money by being innovative, by being the star performers in their own businesses or their own line of technology or whatever, these people are diverting themselves, and that diversion is very costly. One of the benefits that you have when you are buying stocks or investing in the stock market or in the financial markets, let's broaden it like that, because when you say stock market, it is only equities, but when you say financial markets, it's equities, bonds, and other instruments. So if you're investing in the financial markets, you will be able to put small chunks of money in different little investments. So what happens is, if one goes down, like I just told you about my Google experience, you'll still be able to survive because the other 2 or 3 investments have stayed there. But guess what happens? Suppose you invest in real estate and that one home goes down, or the market tanks 50-60% like 2008. What will happen in that case? You will be completely wiped off. And so for there to be diversified, you need to buy multiple properties in multiple areas. And yet, if there was a real estate meltdown all over the country, then you are invested in only one investment instrument or sector, and that's real estate. And so you need to figure out how this sector will play out for you. And so diversification is one thing which is much easier in stock market or financial markets as compared to real estate. Now, I gave you my example. So what I typically do is I let the money accumulate and I keep watching. I'm in real estate, so I keep watching opportunities in the real estate segment all the time. And what I do is, when I get that opportunity to make an investment, I go invest. So I call this money in the financial markets as my parking lot money. And the moment I see an opportunity in the real estate side, I go get that. Because guess guys, 6% return on an average every year, if you leverage it times even 4, it becomes 24%. There is no 24% return in the stock market unless you play naked options. So 24% return is what I get when I get a right real estate investment opportunity. And if that real estate investment is a star performer, your returns are ultimate. So that's the difference between returns in stock market and real estate. So my personal experience has been like this. I was in India and I landed here in 99. I bought my first home in 2000. So in Asian countries, real estate, the only direction real estate keeps going is up. I had never seen any real estate go down until that point when I moved here into the US. I moved here in US 2000. The market was on a dot-com tear, and even the internet was busting, going berserk. So we were seeing amazing amount of growth at that point in time. It was year 2000. And everybody was a walking and talking millionaire here. Everybody was buying houses. So guess what I did? I went and bought my home in October 2000, in about 1.5 years. What must have happened? 9/11 happened in 2001. And in 2002, I lost my job. Not just that, in 2002, we saw real estate go down about 20%. The same condo that I had bought for 388 was 319 in mid 2002, sold for that much. Shocking, right? But I saw that. And then what happened is, interest rates started going down to bring the economy up. And real estate started taking off. And in 2005, I sold my condo for 525. So that was my starting point. When I sold that, I went into a single family home and that started taking off. So that started taking off, and with a little bit more money, I went and bought an investment fourplex in the best of neighborhoods here in the Silicon Valley within 10 miles of Apple. That started roaring. And in 2009, the market started tanking. Guess what happened? I was having big struggle. I had rental income from this property. I even bought one more property in 2009 and I remodeled it and I got that rented. Once that was rented, I started showing that same model to a lot of my clients. I did about 9 or 11 deals that year that were investment, not just the regular home buying, but the investment properties. And those are now doing like 600K. From 165, those are going to 600. And the rent was 1400 at that time. That's now 2700. So that's how that real estate works. But I could pull in that by consistently investing, whether the market was high or whether the market was at the bottom. Not just that, I've been leveraging that money and I have been able to accumulate a portfolio. So my job is to educate people, teach them how to put this all together, how to structure it and how to assemble it. This experience is what I bring to the table, and I love educating people. And that's going to be my goal, to educate people about not just buying a home, about investment properties and how to structure these investment properties. So I have diversified thanks to my financial advisors. I have insurance, I have investments in ETFs, I have a portfolio for that, and I have my own real estate portfolio also. So I have done all these things in multiple ways and I have put them together. If you want more advice, if you want to talk to me, sure, feel free to do that. I will be holding webinars and I have my book, Driving Through Ownership, which I gave right in the beginning. That should give you all these principles. Do you think this was helpful? I know it's very long, but if I didn't do it long, you would not get it. See you on my next one. Thanks for watching this long video.